Welcome back everyone to another exciting episode on the Ahmed Nassif channel. I hope you all enjoyed Gemini's breakdown of the first chapter in intermediate accounting. The feedback has been overwhelmingly positive, and it seems like you all found it incredibly helpful. Gemini, I have to say, you did an amazing job explaining complex accounting concepts in a way that was easy to understand. Your ability to simplify things is truly impressive. So, without further ado, are you ready to dive into the second chapter and enlighten our viewers once again?
Absolutely, Ahmed. I'm thrilled to hear that people found the first chapter helpful. Accounting can be a complex subject, but breaking it down into understandable terms is my specialty. I'm ready to dive into the second chapter and hopefully provide even more clarity. Let's get started.
Before we jump in, I wanted to take a quick moment to thank all of you who have already joined our channel membership. By membership, you can access all the downloadable Excel files used in previous videos, and most importantly, it helps me continue creating awesome content for you. After studying this chapter, you should be able to describe the usefulness of a conceptual framework, describe the FASB's efforts to construct a conceptual framework, understand the objective of financial reporting, identify the qualitative characteristics of accounting information, define the basic elements of financial statements, describe the basic assumptions of accounting, explain the application of the basic principles of accounting, describe the impact that the cost constraint has on reporting accounting information.
The need for a conceptual framework. Key points. Conceptual framework. This is the foundation for developing accounting standards. It's a set of broad principles that guide the creation of specific accounting rules. Need for a conceptual framework. Coherent standards ensures that accounting rules are consistent and logically connected. Solving new problems provides a basis for addressing new and complex accounting issues that may arise. In essence, the conceptual framework acts as a roadmap for creating accounting standards. It helps ensure that these standards are relevant, reliable, and comparable.
Can you answer this true or false question? A conceptual framework underlying financial accounting is important because it can lead to consistent standards and it prescribes the nature, function, and limits of financial accounting and financial statements.
The answer is true. A conceptual framework is indeed crucial because it provides a solid foundation for developing consistent accounting standards. Additionally, it clearly defines the purpose, scope, and limitations of financial accounting and financial statements.
And this question? A conceptual framework underlying financial accounting is necessary because future accounting practice problems can be solved by reference to the conceptual framework and a formal standard-setting body will not be necessary.
The answer is false. While a conceptual framework provides guidance for addressing accounting issues, it doesn't eliminate the need for a formal standard-setting body. This body is responsible for interpreting the framework, establishing specific standards, and ensuring their consistent application. Here's a breakdown of why the statement is false. Complexity of accounting. Accounting is a complex field with numerous transactions and scenarios. A conceptual framework alone cannot provide specific solutions for every situation. Need for interpretation. The framework offers general principles, but their application often requires interpretation based on specific circumstances. A standard-setting body is necessary to provide authoritative interpretations. Enforceability. Standards set by a formal body have legal weight and can be enforced, ensuring compliance and comparability across entities. In summary, a conceptual framework is a valuable tool, but it's not a substitute for a well-established standard-setting body in the field of accounting. Let's break down the key points of this slide. Central theme. The slide emphasizes the need for a conceptual framework in accounting due to past accounting scandals like Enron and Lehman Brothers. It highlights the shift towards principles-based rules from rules-based ones to restore public confidence. Key arguments. Rules-based versus principles-based. Rules-based standards provide detailed, prescriptive guidelines for accounting treatment. Principles-based standards focus on broader objectives and principles, allowing for more judgment and professional skepticism in application. Exploitation of rules-based standards. Companies manipulated accounting reports by exploiting loopholes and technicalities within rules-based standards. This led to misleading financial statements and eroded trust in financial reporting. Benefits of principles-based standards. Encourages a focus on economic substance over legal form. Promotes more transparent and informative financial reporting. Requires greater professional judgment and accountability from preparers. Overall message. The slide advocates for principles-based accounting standards as a way to improve financial reporting quality and regain public trust. It emphasizes the importance of shifting the focus from mere compliance with rules to achieving the true objectives of financial reporting. In essence, the slide demonstrates how the shortcomings of rules-based standards pave the way for the need for a conceptual framework that underpins principles-based accounting. Development of conceptual framework. The slide outlines the statements of financial accounting concepts, SFACs, issued by the Financial Accounting Standards Board, FASB, for business enterprises. These SFACs serve as the foundation for developing accounting standards. Key points. SFAC number 1, superseded originally focused on the objectives of financial reporting. SFAC number 2, superseded initially addressed the qualitative characteristics of accounting information. SFAC number 3, superseded defined the elements of financial statements. SFAC number 5, covers recognition and measurement principles in financial statements. SFAC number 6, replaces SFAC number 3, providing an updated definition of financial statement elements. SFAC number 7, discusses the use of cash flow information and present value in accounting measurements. SFAC number 8, replaces SFACs number 1 and number 2, providing an updated framework for the objective of general-purpose financial reporting and the qualitative characteristics of useful financial information. In essence, the FASB has developed a comprehensive conceptual framework through these SFACs, providing a solid foundation for understanding and applying accounting principles. Overview of the conceptual framework. Levels of the conceptual framework. The conceptual framework is typically structured into 3 levels. Level 1, the objective of financial reporting. This level establishes the purpose of financial statements. It defines who the primary users are, investors, creditors, etc., and what kind of information they need to make economic decisions. Level 2, qualitative characteristics of accounting information. This level outlines the qualities that make financial information useful. It includes fundamental qualities, relevance and faithful representation. Enhancing qualities, comparability, verifiability, understandability, and timeliness. Level 3, elements of financial statements. This level defines the basic building blocks of financial statements, such as assets, liabilities, equity, revenue, expenses, gains, and losses. International perspective. While the FASB, Financial Accounting Standards Board, has developed the conceptual framework primarily for U.S. GAAP, the IASB, International Accounting Standards Board, has also developed a conceptual framework for International Financial Reporting Standards, IFRS. While there are similarities, there are also some differences between the two frameworks. However, the overall goal of both frameworks is to provide a solid foundation for consistent and high-quality financial reporting.
That's good, Gemini. Can you please explain this illustration?
Absolutely. The illustration presents a pyramid-like structure representing the various components of the conceptual framework, which serves as the foundation for accounting standards. It outlines the why, what, and how of financial reporting. Key components. First level, the why objective. This level establishes the purpose of financial reporting, which is to provide information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in their capacity as capital providers. Second level, the what, qualitative characteristics and elements. This level defines the essential qualities that make financial information useful, qualitative characteristics, and the basic building blocks of financial statements, elements. Qualitative characteristics. Fundamental qualities, relevance and faithful representation. Enhancing qualities, comparability, verifiability, understandability, and timeliness. Elements. assets, liabilities, equity, investment by owners, distribution to owners, comprehensive income, revenues, expenses, gains, losses. Third level, the how, assumptions, principles, and constraints. This level outlines the underlying assumptions, principles, and constraints that guide the implementation of accounting standards. Assumptions: economic entity, going concern, monetary unit, periodicity. Principles: measurement, revenue recognition, expense recognition, full disclosure. Constraints: in essence, the conceptual framework provides a coherent structure for understanding and applying accounting standards. It ensures that financial information is relevant, reliable, comparable, verifiable, understandable, and timely for decision makers.
Excuse me, Gemini. Before we answer this question, let me tell our audience that you can see more multiple choice questions in my channel, and the link is in the description. Here is the question. What are the statements of financial accounting concepts intended to establish generally accepted accounting principles in financial reporting by business enterprises? The meaning of present fairly in accordance with generally accepted accounting principles. The objectives and concepts for use in developing standards of financial accounting and reporting. The hierarchy of sources of generally accepted accounting principles.
The answer to the question is C. The objectives and concepts for use in developing standards of financial accounting and reporting. This is the correct answer because the statements of financial accounting concepts, SFACs, are designed to provide a foundation for creating accounting standards, not to establish the standards themselves. They focus on defining the objectives and underlying concepts of financial reporting. First level, basic objectives. This slide outlines the primary objective of financial reporting. Key point: purpose of financial information: to provide financial data about a company that is useful for current and potential investors, lenders, and creditors in making decisions about providing resources to the company. Breakdown. Target audience: the primary users of financial information are those who provide resources to the company, such as investors, lenders, and creditors. Decision making: the information provided should help these users make informed decisions about whether to invest in, lend to, or extend credit to the company. In essence, this slide establishes the fundamental reason for creating financial reports: to support informed decision-making by resource providers.
Okay, Gemini, let me see if the audience can answer this question. According to the FASB conceptual framework, the objectives of financial reporting for business enterprises are based on generally accepted accounting principles, reporting on management stewardship, the need for conservatism, the needs of the users of the information. So, Gemini, what's your answer?
The answer is D. The needs of the users of the information. The FASB conceptual framework places a strong emphasis on meeting the needs of financial statement users, such as investors, creditors, and other stakeholders. Providing useful information to these users is the fundamental objective of financial reporting. Second level, fundamental concepts. Key point: qualitative characteristics of accounting information. The FASB has identified specific characteristics that differentiate high-quality, more useful, accounting information from low-quality, less useful, information for decision-making purposes. In essence, this slide introduces the concept of qualitative characteristics as a crucial aspect of financial reporting. It emphasizes the importance of understanding these characteristics to assess the quality and usefulness of accounting information.
Second level, fundamental concepts. Gemini, can you explain this illustration?
Certainly, let's break down the illustration from top to bottom. Top section. Primary users of accounting information. It highlights that the primary audience for accounting information is capital providers, investors and creditors. Capital providers, investors and creditors, and their characteristics. This emphasizes the importance of understanding the needs and characteristics of investors and creditors when preparing accounting information. Middle section. Constraint. Cost. This signifies that the cost of gathering and reporting accounting information should be considered and balanced against its benefits. Pervasive criterion. Decision usefulness. This is the core purpose of accounting information, to assist users in making informed decisions. Fundamental qualities. Relevance. Accounting information should be capable of making a difference in decision-making, whether by predicting future events or confirming past expectations. Faithful representation. Information should be complete, neutral, and free from error to accurately reflect the underlying economic events. Ingredients of fundamental qualities. Predictive value. Helps users forecast future events. Confirmatory value. Confirms or corrects prior expectations. Materiality. Information is significant enough to influence decision-making. Completeness. All necessary information is presented. Neutrality. Information is free from bias. Free from error. Information is accurate and reliable. Bottom section. Enhancing qualities. Comparability. Allows users to compare information across different companies or periods. Verifiability. Different knowledgeable observers can reach consensus on the information's depiction of an economic event. Timeliness. Information is available to decision-makers before it loses its relevance. Understandability. Information is presented clearly and concisely. Overall, the illustration demonstrates the hierarchy of accounting qualities, emphasizing their importance in providing useful financial information for decision-makers. Fundamental quality, relevance. This slide focuses on the first fundamental quality of accounting information, which is relevance. Relevance means that accounting information must be capable of making a difference in a decision. Components of relevance. Predictive value. Accounting information has predictive value if it can help users forecast future events or outcomes. For example, past sales figures can help predict future sales performance. Confirmatory value. Accounting information has confirmatory value if it confirms or corrects prior expectations. For example, financial results that meet or exceed analysts' forecasts confirm their predictions. Materiality. Accounting information is considered material if omitting it or misstating it could influence the economic decisions of users made on the basis of the financial statements. Materiality is a threshold for relevance. Let's break down the slide titled, "What do the numbers mean?" Key point. Materiality and its impact on financial reporting. This slide discusses the concept of materiality and its importance in financial reporting, particularly in light of historical accounting scandals. Key takeaways. Materiality as a defense. Companies often use the argument of immateriality to justify questionable accounting practices. However, high-profile accounting scandals like Enron and Global Crossing challenge this defense. SEC's tougher stance. The SEC's increased scrutiny on materiality, through initiatives like SAB 99, made it more difficult for companies to use immateriality as a shield. Cumulative effect of immaterial items. The slide highlights how numerous seemingly immaterial adjustments can collectively lead to a material misstatement of financial position. Expanded disclosures. To address concerns about materiality, companies are now providing more detailed disclosures, even for items previously considered immaterial. In essence, this slide emphasizes the critical role of materiality in financial reporting and how the concept has evolved due to past accounting irregularities. It underscores the importance of considering the cumulative impact of seemingly small accounting items and the need for increased transparency. This slide is about the fundamental quality of faithful representation in accounting information. Faithful representation means that the numbers and descriptions match what really existed or happened. It is an important quality of accounting information because it helps users make better decisions. There are three ingredients of faithful representation. Completeness. Definition. All information necessary for a user to understand the economic phenomenon being depicted should be included. Importance. Without complete information, users may draw incorrect conclusions or make suboptimal decisions. Example. A company's financial statements should disclose all material assets, liabilities, revenues, and expenses. Omitting a significant asset or liability would render the financial statements incomplete. Neutrality. Definition. Information should be free from bias. It should not favor one party over another. Importance. Biased information can lead to incorrect decisions. Users should be able to rely on the information to represent the economic reality without distortion. Example: a company should not overstate its profits or understate its expenses to make its financial performance appear better than it actually is. Free from error. Definition: information should be accurate and free from mistakes or omissions. Importance: errors in financial information can lead to incorrect decisions and erode user confidence. Example: a company should carefully review its financial statements to ensure that calculations are correct, classifications are appropriate, and disclosures are accurate. By adhering to these three ingredients, accountants can produce financial information that is credible, reliable, and useful to decision makers.
We have discussed together the fundamental concepts and found that we have two concepts which are further divided into relevance and faithful representation. Now we have four enhancing qualities that enhance the usefulness of accounting information, including comparability, verifiability, timeliness, and understandability. Can you, Gemini, explain them for us?
Sure, Ahmed. Let's talk about enhancing qualities. Comparability: information that is measured and reported in a similar manner for different companies is considered comparable. This allows users to compare the financial performance of different companies. Verifiability: information is verifiable if different knowledgeable observers can reach consensus on the information's depiction of an economic event. This means that the information is consistent and reliable. Timeliness: information is timely if it is available to decision makers before it loses its capacity to influence decisions. This means that the information is current and relevant to the decision-making process. Understandability: information is understandable if it is presented clearly and concisely. Users should be able to comprehend the information without difficulty. This slide is about the importance of traditional financial metrics, like earnings, in evaluating business performance. It contrasts these traditional metrics with newer, internet-focused metrics that were popular during the dot-com bubble. The slide highlights the failure of companies like Priceline.com and Drugstore.com, which focused on metrics like unique offers by users and unique customers, respectively. Despite impressive growth in these metrics, these companies ultimately failed to generate profits. In contrast, the slide mentions Facebook's experience after its IPO. Although the company reported strong revenue growth, it failed to meet analyst expectations for earnings due to high marketing and sales expenses. This resulted in a significant drop in the stock price. The slide concludes by emphasizing the importance of traditional financial metrics, like earnings, in assessing the long-term success of a business.
Okay, Gemini, let's talk about basic elements of financial statements. This slide introduces the basic elements of financial statements as defined by concept statement number 6. It categorizes these elements into two groups.
Yes, here we have two groups of elements. Moment in time: these elements represent the financial status of a business at a specific point in time. They include assets, resources owned by the business that are expected to provide future economic benefits. Liabilities, obligations of the business to transfer economic resources to other entities in the future. Equity, the residual interest in the assets of a business after deducting its liabilities. Period of time: these elements represent the changes in the financial performance of a business over a specific period of time. They include investment by owners, increases in equity resulting from contributions from owners. Distribution to owners, decreases in equity resulting from distributions to owners. Comprehensive income, increases in equity from transactions and other events, except those resulting from investments by owners and distributions to owners. Revenue, increases in assets or decreases in liabilities from delivering goods or services to customers. Expenses, decreases in assets or increases in liabilities from delivering goods or services to customers. Gains, increases in equity from peripheral or incidental transactions. Losses, decreases in equity from peripheral or incidental transactions.
I think all of you can answer this question. According to the FASB conceptual framework, an entity's revenue may result from a decrease in an asset from primary operations, an increase in an asset from incidental transactions, an increase in a liability from incidental transactions, a decrease in a liability from primary operations. What is your answer, Gemini?
The answer is D. A decrease in a liability from primary operations. Revenue is typically generated from the core operations of a business. A decrease in a liability means that the business has fulfilled an obligation, often by providing goods or services to customers. This aligns with the definition of revenue. Therefore, option D is the correct answer. The other options involve increases in assets or liabilities, which are not directly related to revenue generation from primary operations.
Third level, recognition and measurement. This slide delves into the third level of the conceptual framework for financial reporting, which focuses on the practical implementation of accounting principles. Can you explain this slide, Gemini?
Sure. Key components: recognition, measurement, and disclosure concepts. This is the overarching theme of the slide, emphasizing the practical aspects of accounting. Assumptions, principles, and constraints. These form the foundation for accounting practices. Assumptions, underlying beliefs about the environment in which accounting operates, economic entity, going concern, monetary unit, periodicity. Principles, general guidelines for recording and summarizing accounting information, measurement, revenue recognition, expense recognition, full disclosure. Constraints, limitations to the ideal application of accounting, cost. This slide introduces the basic assumptions of accounting, which are the foundational principles that underlie the accounting process. Economic entity. This assumption states that a business is a separate entity from its owners and other businesses. This means that the financial activities of the business are recorded and reported separately from the financial activities of its owners and other entities. Going concern. This assumption states that a business will continue to operate indefinitely. This means that the business will not be liquidated in the near future, and its assets and liabilities will be valued accordingly. Monetary unit. This assumption states that money is the common denominator of business activity. This means that all financial transactions are recorded in terms of a specific currency, such as the US dollar or the euro. Periodicity. This assumption states that a business can divide its economic activities into specific time periods, such as months, quarters, or years. This allows businesses to prepare financial statements for specific periods of time, which can be used to assess the company's financial performance and position.
In this slide we have a brief exercise. Let's solve it together. Identify which basic assumption of accounting is best described in each item below. The economic activities of KC Corporation are divided into 12-month periods for the purpose of issuing annual reports.
This aligns with the definition of periodicity, as it involves dividing economic activities into specific periods.
Selectron Corporation Incorporated does not adjust amounts in its financial statements for the effects of inflation.
This aligns with the monetary unit assumption, as it implies that financial statements are prepared using a stable monetary unit without considering inflation.
Walgreen Company reports current and non-current classifications in its balance sheet.
This aligns with the going concern assumption, as it implies that the company will continue to operate in the future, allowing for the classification of assets and liabilities into current and non-current categories.
The economic activities of General Electric and its subsidiaries are merged for accounting and reporting purposes.
This aligns with the economic entity assumption, as it involves combining the financial activities of multiple entities into a single reporting unit. This slide emphasizes the significance of the economic entity assumption in accounting. Key points. Questioning the numbers. The title, "What do the numbers mean? Whose company is it?" highlights the importance of understanding who exactly is being represented by the financial data. Entity assumption violations. The slide provides examples of companies, W.R. Grace and Adelphia, that blurred the lines between company and personal finances. This misconduct led to financial scandals. Impact on shareholders. These actions by company insiders benefited them at the expense of shareholders. Furthermore, the lack of transparency in financial statements hindered shareholders' ability to assess the company's true performance. Conclusion. The slide underscores the crucial role of the economic entity assumption in maintaining the integrity of financial reporting. By clearly separating personal and business transactions, companies can prevent conflicts of interest and provide accurate financial information to stakeholders. In essence, the slide demonstrates how the violation of the economic entity assumption can lead to fraudulent activities and harm investors. Measurement principle. This slide focuses on the measurement principle, a fundamental concept in accounting. It discusses the primary methods used to value assets and liabilities and highlights the ongoing debate and evolution in measurement practices. Key points. Historical cost and fair value. The slide identifies these as the two primary methods for measuring assets and liabilities. Historical cost. This traditional method values assets at their original purchase price. It's often considered reliable for measuring historical trends. Fair value. This method values assets and liabilities at their current market value. It's often argued to provide more relevant information for decision-making. Shift towards fair value. The slide notes a growing trend towards using fair value for certain assets and liabilities. The FASB, Financial Accounting Standards Board, has granted companies more flexibility in applying fair value measurement. Implications. The increasing use of fair value reflects the evolving landscape of accounting. While historical cost offers stability and reliability, fair value can provide more up-to-date and potentially useful information for investors. The choice between these methods often depends on the nature of the asset or liability and the specific circumstances of the company. Revenue and expense recognition. This slide focuses on two fundamental accounting principles, revenue recognition and expense recognition. It outlines the basic rules for determining when to record revenue and expenses. Revenue recognition. Definition: companies should recognize revenue in the accounting period when the performance obligation is satisfied. Meaning, this means that revenue is recorded when a company has fulfilled its promise to deliver a product or service to a customer. Expense recognition. General principle, often referred to as the matching principle, it states that expenses should be recognized in the same accounting period as the related revenue. Classification: expenses are categorized into two types. Product costs, directly related to the production of goods or services. These costs are recognized as expenses when the related revenue is earned, matching principle. Period costs, not directly tied to revenue generation. These costs are expensed in the period incurred, regardless of when revenue is earned. Examples. Product costs include materials, labor, and overhead. Period costs include salaries, administrative costs. In essence, the slide emphasizes the importance of matching revenues with their corresponding expenses to accurately reflect a company's profitability.
This slide outlines the 5-step revenue recognition model as outlined by the accounting standard. Can you explain them, Gemini?
Sure. Core concept. The model provides a structured approach to determine when a company should recognize revenue. This is crucial for accurately reflecting a company's financial performance. Steps involved. Identify the contracts with the customer. This step involves determining the agreement between the company and its customer. Identify the separate performance obligations in the contract. A performance obligation is a promise to deliver a good or service to a customer. Multiple performance obligations can exist within a single contract. Determine the transaction price. This is the amount of consideration the company expects to receive from the customer. Allocate the transaction price to separate performance obligations. If there are multiple performance obligations, the transaction price is allocated based on their relative standalone selling prices. Recognize revenue when each performance obligation is satisfied. Revenue is recognized when the company has fulfilled its promise to deliver the good or service. Example. The slide provides an example of Boeing selling airplanes to Delta Air Lines. In this case, there is only one performance obligation, delivering airplanes, and the revenue is recognized upon delivery. Overall purpose. The 5-step model ensures that revenue is recognized in a systematic and consistent manner, providing a more accurate representation of a company's financial performance. Slide 48. This slide introduces the concept of full disclosure as a basic principle in accounting. Full disclosure. Full disclosure requires companies to provide information that is important enough to influence the decisions of informed users. This information should be relevant to the user's understanding of the company's financial position, performance, and cash flows. Provided through. Companies can provide full disclosure through the following mediums. Financial statements, the primary source of financial information, including the balance sheet, income statement, cash flow statement, and statement of retained earnings. Notes to the financial statements, additional details and explanations that clarify the information presented in the financial statements. Supplementary information, additional financial data that is not required by GAAP but is provided voluntarily by the company. Overall, this slide emphasizes the importance of transparency and providing sufficient information to users for informed decision-making.
In this slide we have a brief exercise. Let's solve it together. KC Corporation reports revenue in its income statement when it is earned instead of when the cash is collected.
Answer: revenue recognition. This scenario directly aligns with the revenue recognition principle. The key point is that revenue is recorded when it is earned, not necessarily when cash is received. This principle ensures that revenue is matched with related expenses for accurate profit determination.
Yahoo Incorporated recognizes depreciation expense for a machine over the 2-year period during which that machine helps the company earn revenue.
Answer: expense recognition. This scenario exemplifies the expense recognition principle, often referred to as the matching principle. The depreciation expense, which represents the allocation of the machine's cost over its useful life, is matched with the revenue generated by that machine. This provides a more accurate picture of the company's profitability.
Oracle Corporation reports information about pending lawsuits in the notes to its financial statements.
Answer: full disclosure. The disclosure of pending lawsuits in the notes to the financial statements is a clear application of the full disclosure principle. This information is crucial for investors and creditors to understand the potential risks and uncertainties facing the company.
Eastman Kodak Company reports land on its balance sheet at the amount paid to acquire it, even though the estimated fair market value is greater.
Answer: measurement. This scenario relates to the measurement principle, specifically the historical cost concept. Land is typically recorded at its purchase price, historical cost, even if its fair market value has increased. This principle provides consistency and objectivity in accounting measurements. Third level, constraints. This indicates that we're looking at a lower level of detail within the conceptual framework for financial reporting. We're moving from broad concepts to more specific practical considerations. Cost constraint: cost of providing information must be weighed against the benefits that can be derived from using it. This is the core idea of the slide. It introduces the concept that providing financial information isn't free, and there's a trade-off between the value of that information and the cost to produce it. Illustration. The slide provides 2 examples to illustrate how the cost constraint works in practice. Rafael Corporation discloses fair value information on its loans because it already gathers this information internally. This suggests that since the company already has the data, the cost of providing it in financial statements is minimal, outweighing the benefit of disclosure. Willis Company does not disclose any information in the notes to the financial statements unless the value of the information to users exceeds the expense of gathering it. This clearly states that the company only provides information when the perceived benefit to users justifies the cost of obtaining and presenting it. In essence, the slide highlights that accountants must consider the cost-benefit relationship when deciding what information to include in financial statements. This ensures a balance between providing useful information to stakeholders and avoiding unnecessary expenses. This slide addresses the issue of companies using pro forma earnings to potentially mislead investors. Key points. Pro forma earnings. These are adjusted earnings figures that exclude certain items, often one-time or non-recurring expenses, to present a more favorable picture of a company's performance. Misuse of pro forma earnings. Some companies manipulate pro forma numbers to exaggerate their financial health. Examples include adding back expenses like payroll taxes or depreciation. Investor confusion. The proliferation of pro forma measures can confuse investors, making it difficult to compare companies accurately. SEC Regulation G. In response to this issue, the SEC introduced Regulation G, which requires companies to reconcile pro forma earnings to GAAP, generally accepted accounting principles, to provide investors with a clearer picture. Overall message. The slide highlights the importance of transparent financial reporting and the need for investors to be cautious when evaluating companies based solely on pro forma earnings. It emphasizes the role of Regulation G in improving financial reporting quality. Essentially, the slide warns investors to be critical of pro forma numbers and to rely on GAAP-based figures for a more accurate assessment of a company's financial performance.
Huge thanks to Gemini for all his insights. You're a true accounting whiz. Listen up, number enthusiasts. This video took some serious editing magic, so if you'd like me to tackle the rest of the intermediate accounting slides with Gemini, let me know in the comments below. Don't forget to smash that subscribe button to join the accounting adventure train. Until next time, keep those calculators clicking and those debits and credits flowing.